South Africa's central bank kept its main interest rate unchanged on Wednesday, saying its policy stance still needs to be restrictive to address elevated inflation expectations. This comes even as inflation rose to 5.6% year-on-year in February from 5.3% in January, nearing the top of the central bank's preferred range. In a statement accompanying its decision, the bank said that headline inflation was now expected to reach the midpoint of its target range, 4.5% only at the end of 2025, later than previously forecast. Joining me for more on this is Professor Waldo Krugell, an economist at the Northwest University. Thank you, Prof, for joining me today.
Good morning. Thanks for the opportunity.
All right, so the repo rate is held at 8.25%, much to the expectation of analysts. Was this also what you expected?
Yes, I think everybody was in consensus that it's not really possible to cut the rate at the moment, particularly with the two latest inflation data points showing an increase. The Reserve Bank is not convinced that inflation is trending downwards in the way that they would like it to see towards that midpoint of the target band. It leaves them little choice, and at least they decided to maintain the rate unchanged.
Well, this is the SARB's, fifth consecutive hold on the repo rate. And this particular one comes after inflation hit a 4-month high last month. Don't you think that might be an indication that the Apex Bank may need to, tighten the rate to further rein in inflation?
For the sake of our consumers, I hope not. But there are worrying indications of more pressure on prices. The moment that the rand-dollar exchange rate weakens, that's detrimental to the cost of imported goods. And in addition to that, we are also struggling with an El Nino-induced drought, and crop estimates are down significantly from last year, which could put pressure on food prices again. So with those two dynamics, it's clear why the bank expects a very slow decline back to that midpoint over the course of this year and next year. It seems that inflation is likely to stay a bit higher for longer.
Well, apart from the monetary tools that, the bank has been using, you've talked about some of the things that do not sound like, factors that fall within the purview of the monetary authority. So what is the fiscal authority? What is the government doing to address some of those things? I know some of them are probably, they are not human in nature. You can't probably control some of these things. And some of these risks are also probably global, not domestic. So, but what is being done to ensure that these risks are also, taken care of?
I think that the broader effort is to have policy stability, particularly on the fiscal side. And the Minister of Finance has been following a process of fiscal consolidation, trying to cut back on the interest on the debt and the debt itself, and in that way providing a more stable platform for the exchange rate. There's also some relief for consumers, those that get the 350 Rand grant. That's been increased to 370 rands now. It's not a lot, but it helps a little bit to just ameliorate those effects of higher inflation rates. I think the key thing is, though, is that a portion of that high inflation rate has to do with administered prices, the price of electricity, water, local municipal rates, etc. They've been increasing at rates above the target for a while now. And they are difficult to get lower, mainly because those authorities need the money to keep providing services. And I think that puts a floor under the inflation rate and undermines the Reserve Bank's ability to really decrease that rate back to 4.5%.
All right, well, so talking about, holding or hiking a rate, there are multiple expectations for when South Africans should start expecting rate cut. Some analysts believe, February figures have further pushed the likely period forward. What are your own thoughts on when citizens should expect a rate cut in South Africa?
From a practical point of view, the next MPC meeting is the day after the elections in May. So it's unlikely that we'll see a change then. The meeting after that is mid-July. So that's really the first opportunity to cut rates. And that is going to depend on the data that becomes available in the meantime. And the bank will have to see a significant slowdown in inflation to be able to reduce rates then. I think that's why analysts are expecting even later in the year and a smaller number of decreases as well. So it's come down to maybe 2 to 3 25 basis points reductions before November, which leaves it quite late as relief for consumers. In addition, I should say, it's unlikely that the Reserve Bank here will move before the US Fed does. So in that sense, our intricate links via the exchange rate are such that we would have to wait for them to start cutting rates before we do.
All right, so talking about inflation really in South Africa, it hit 5.6% in February from 5.3% in January. Do you see this as a one-off, or do you have fears that inflation might continue to trend upward in the coming months?
There are elements that are once-off. For example, medical insurance costs are only accounted for once a year in the inflation figures, and they got added in the January numbers. And those increases were also quite above the target band, higher than 6%. So that contributes. And we know that there were also fuel price increases in both January and February that would have an impact on that rate. The fuel price increases, though, are linked to oil price and the rand-dollar exchange rate, and those could be recurring. At least what we're seeing for April is a small increase, but going forward, those are two big unknowns that's going to influence the inflation rate locally.
All right, so what are your suggestions really for addressing inflation in South Africa, for tipping it down? What are your suggestions, whether it's a monetary policy tool or even, a fiscal tool or whatever it is really, so we can address it? I know you've mentioned some of the things that are responsible for this, but yeah, it's good to see the causes, but we also need to know how to, work on this thing so we can have the effect.
I think the Reserve Bank's role is the slow grind of keeping rates higher for longer and keeping consumer spending lower to in that way slowly just get the inflation out of the system. But it's a painful way of doing it. A bigger jump can be twofold. One would be to make policies and reforms following the election that would give a confidence boost to the rand, get investors back into our bond market, and in that way solve these problems of a very volatile exchange rate. If we can get a slightly stronger and stable exchange rate, that would do a lot for the inflation outlook. On the other side, a lot of those reforms have to do with the fiscal side, with institutions like Eskom and the local governments. And if they were able to keep their price increases in years to come within the target range, again, that would make a major difference to the Reserve Bank's efforts. But that requires really large-scale reforms that are complicated and time-consuming.
Well, a hold on repo rate also means banks will maintain their prime lending rate. I mean, it goes together. How are businesses and investors taking this decision? Because here in Nigeria, the private sector isn't taking it sitting down or smiling. So how are businesses and individuals, responding or reacting to this, knowing that the repo rate is much higher than even the inflation rate we're talking about in South Africa?
They're taking it hard. There's a fair bit of news in the business media, but you can see the impact of this on business confidence, on consumer confidence. It's in the purchasing managers' indices. Everybody's quite downbeat about the prospects for the economy until interest rates start coming down. And in a way, this negative sentiment further reduces investment that is desperately needed to get the economy growing at a faster rate than we are at the moment. And I think even the banks who tend to do well when interest rates are high are reporting more bad debts, people who can't repay their loans, and they are slowly coming under pressure. So there's no doubt that this high repo rate is having a huge impact on the demand side of the economy.
That's not a very good one. I mean, talking about default on loans, it's not a very good one. But then the South African Reserve Bank actually said in a statement accompanying its decision that headline inflation was not expected to reach the midpoint of its target range, that's 4.5%, only at the end of 2025, later than its previously, forecast. Do you share the same sentiment?
Unfortunately, yes. I think the factors that are keeping inflation high are exactly the sorts of things that the bank has little control over, and the interest rate tool that they're using to dampen economic activity in order to get that price pressure out of the economy is a rather blunt one, and it's a slow grind to get to that much lower level of inflation. Convincing people to reduce their inflation expectations while when they go to the shops they still see prices increasing is really difficult, and I think it's an uphill battle to get back to that midpoint.
All right, thank you so much, Professor Krugell, for sharing your thoughts with us today on Business Edge.
You're welcome. Thank you.
All right, that's it on this edition of Business Edge. Many thanks for watching. You can follow us on social media. We are at New Century TV. You can also head on to our website, www.newcentral.africa. You can download our mobile app on Play Store and on App Store. Thank you for watching. Till next time, I am Perpetua Fasanmi-Peter. Bye for now.